Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management, will be joining us for the hour. And of course, we want to hear from you this morning on First Call. Reach out with your questions, and we'll have Andrew answer as many of them as he can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes, and our email address, if you're shy, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Oracle are soaring in the pre-market, up 9.25 right now. The software company beat revenue expectations and posted a 68% sales rise from the previous quarter. Oracle is working to deliver on massive cloud infrastructure contracts with customers like OpenAI and Meta. The American company says it is delivering cloud capacity to customers with 90% in the quarter completed or ahead of schedule. Bloomberg is reporting the International Energy Agency is proposing a release of emergency oil reserves in the range of 3 to 400 million barrels. According to the report, this would be the largest release in history. The decision comes as governments are seeking to contain a spike in energy prices driven by the Middle East war. The decision is possible later today, with G7 ministers meeting again to further their discussions. And now our top line story. A spokesperson for Energy Minister Tim Hodgson said Canada is, quote, urgently exploring options with provinces and the energy industry to boost oil supply as trade disruptions caused by the war in the Middle East spur huge volatility in global crude markets. For more on the latest in the Middle East and the ramifications on the oil market, let's bring in our guest for the hour, Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management.
Great to be here.
That is a long title. But
that is a long title.
Always good to have you here, especially with the rain we're getting in Toronto. Thanks very much.
Pleasure to be here.
Coming in, hopefully the gas wasn't too expensive after the madness that we saw.
There's a little bit of a sticker shock going on now.
There is, isn't it?
Yeah.
It's how fast. They're not wasting any time on locking that in, are they?
No, exactly.
Considering everything that's unfolding. It's been a wild ride for oil. We're seeing today, we're hearing about mining in the Gulf or in the Strait of Hormuz. We are hearing about U.S. strikes on Iranian mine-laying ships, yet oil seems to be kind of calm today.
Well, oil's calm because we've now just announced that we're proposing the largest ever release of reserves by the IEA in history. Bigger than what we saw during Russia's invasion of Ukraine, bigger than the Gulf Wars. So that is going to stabilize the oil market. In the past, when we've seen something like this, it can also work the other way. It can also cause investors to think or to panic that maybe there's something even more serious. Why are we releasing so many barrels from strategic reserves if everything is going to be over in a couple of weeks?
And what's your feeling on that?
Well,
which way are you leaning with that?
I think it's too early to say. I think that the damage is being done to infrastructure. I think a lot of analysts are missing the point. It's not just, can we get some boats through the strait? It's really what has happened to infrastructure in the region. What has happened to tankers? How quickly can we get the supply back? And I think that is the driving force behind what the IEA has announced as a stopgap, because we honestly have no clue where this is going to go in the coming weeks.
And in the grand scheme of things, 3 to 400 million barrels, is that enough? And how long will that last? Will that...
Well, that's a stock question. Like, how many barrels do we have? How many barrels are we going to release? And then you got to get back to the flow. What is the demand situation looking like? How quickly can we get product to refineries, for example? How quickly can we get that into gasoline? So it is a longer process than just flipping a switch, releasing reserves, and then we get stability in the oil market. It's not going to work that way. And that's why oil today is not trading at $70. We're still up in the $90 range. And we're still hearing from Iran that this is not over. They're going to continue to retaliate.
And I just saw Germany has said that they're ready to release part of their reserves. Japan's already doing it by itself. Is that to be expected? Is that a danger that if everybody starts kind of going out on their own on this, or should there be a unanimous look to it?
Well, it's not going to be a unanimous look. Every country is going to look at their own situation in terms of how much supply restraint are we going to face as a country. And every country is going to have to make the decision as to how much they're going to release from their own strategic reserves. We think of this as a coordinated thing. It's some central bank of oil that we're now going to release reserves from to stabilize the market, but it's not like that at all. You have countries, for example, like Canada, that really don't have strategic reserves. So I think every country is going to look at this independently in terms of how they feel that they're going to be impacted longer term.
Now, I just saw there was a story that just came out from the Port of Vancouver. It's seen, I think, 30% increase in oil shipments since the expansion of the pipeline there, and most of it's going to China. Yeah. Which timing of this coming out with everything unfolding in the Middle East? What do you think? I mean, is this showing for Canada at least where we should be going or what we should be doing?
I mean, we've talked about this on the show before. I mean, it's been a long time coming to get that type of infrastructure in place that we can get product from Western Canada to other parts of the world. And we started working on this obviously before the war, not knowing that the war was going to happen. Now that it's happening, we're seeing the benefits of it. So it's not really just diversifying your oil customers. It's actually, you can actually be in a pivotal point at a time when you've got a crisis going on in an area where we're sending 20% of the world's oil daily through. So I think Canada really stands to benefit from this.
And you mentioned that Canada doesn't really have huge reserves, I guess, because we can make a lot of it. But is that a good thing, or can we detour some of the oil that we're shipping elsewhere if we need it?
Well, I think that's something that we need to look at in Canada. I mean, up till now, under the IEA, we're not required to have a strategic reserve. We are a net exporter of oil, so therefore there was no requirement on Canada to actually have that reserve. Should we have one is a different question, and I think a lot of people have looked at this and said, well, you know, we can produce oil out of the West, we can feed ourselves, we can feed the rest of the world, but we start looking at other parts of Canada that don't have that same access to crude and to oil. For example, Ontario in the East. I think that's where we can start looking at maybe there's an argument to be made to have a strategic reserve perhaps in Ontario. Would that help stabilize things for Canada if we truly were in a crisis? And I think that's going to be what's going to be discussed going forward.
And the pandemic kind of showed that with medicine, PPE, all the showed the need to have stockpiles and sources of things. Well, no matter how well you think you are ready for something.
Yeah, I mean, we call it supply lines 2.0. I mean, we've been through enough things right now where you can break a supply line very quickly. And of course, we've been through this period now of deglobalization, which means we don't have that just-in-time inventory anymore. So this is going to be a critical issue, not just on oil, because again, other things are being shipped through the strait. Yeah. It's going to be everything else that we depend on daily, and how do we manage that risk?
All right, lots more to talk about on this when we come back. Up next, so we'll take a look at the markets before the bell. Let's see how things are shaping up on the markets. We'll start with U.S. futures, and everyone feels like it's waiting for the next move. Let's see where they're at. They were trading up slightly earlier, but now they're off. Let's see the S&P. What's it at? Down by 0.12. The Nasdaq by 0.13. The Dow by 0.2. Everybody's just kind of floating around, waiting to see what the next move is now. One mover, though, through all this is Oracle on its earnings released after the bell yesterday. People happy with that one. Heading to Asia now. Let's see what they did for the day. A mixed bag there, with Nikkei looking a little more stable in Japan, with probably the news that Japan may release oil reserves by itself. It was up 1.43. Hang Seng off by a quarter, and the CSI 300 up by 0.64%. Off to Europe now, and risk off there. You can see the cyclicals and rate sensitives are under pressure right now. The FTSE is down 0.85, the CAC 40 by 0.75 of a point, and the German DAX by 1.3%. TSX yesterday finished up by a quarter point, led by materials and financials. Energy and tech, though, were off for the day. Some of the movers, let's take a look. G Mining Venture up by nearly 8%, Silvercore by 6.7%. Going the other way, Thomson Reuters been up and down for the last few weeks, off by 7%. And then Go Easy, of course, on its horrific report, off by 57%. Looking at the metals now, and they were up just a little while ago. Now they're trading down. And gold off by 0.84%, silver 3.33%, and copper down by 1.6%. Taking a look at Western Canadian Select. And yeah, it followed suit with everything else yesterday, off by 11.5% from some highs that we haven't seen in a while. And today, what's WTI doing? It's up 4%. This is probably on the concerns about possible mining in the Strait of Hormuz by Iranian forces, and some ships reportedly being hit by projectiles. It's up 4% right now. Well, as we continue our coverage on the war in Iran and the impact on the markets, let's bring back our guest for the hour, Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management. Andrew, everything Iran right now, and the Strait of Hormuz is the big one. The markets, they seem to have a little more confidence. Today, they're kind of trying to find themselves. Do you see that? Is it a trend, or now today are we going to see another negative reaction to what we've heard from the Gulf?
Well, I hate to say this, but it depends on the headlines between now and the close of trading today. And so this market is going to be hyper-focused on every single headline that comes out of this region, whether we have stability. Again, the release of those reserves has provided some calm to the market. And that's important not just for the energy market, not just for commodities, but also for how we think this is going to play out for the economy, right? Mm-hmm. So whether, if we have prolonged periods of time where oil prices stay high, inflation is higher, perhaps that has an impact on central bank thinking. That has a longer-term impact on equity market volatility and equity market direction. So the stability is great, but I don't think anyone in this market, Roger, is really looking at this and saying, we're done. I think this is going to be a minute by minute over the next few weeks.
Yeah, and of course, situations like this, defense always wins usually. Other sectors that maybe surprising sectors people might not think of that can benefit from this?
Yeah, so we look at wars like this in the same context as a natural disaster. Typically, what would happen after the impact or after the disaster? What happens once this war is concluded, whenever that's going to happen. And typically what we look at are things that have been destroyed during that instant. So infrastructure, and of course there's been a lot of infrastructure damage with this. So we start looking at companies that are going to be in the tanker building business or tanker reconstruction business, ports, energy infrastructure, whether we're talking about LNG plants that have been impacted, all the way down to residential and commercial, Roger, because again, we're seeing increased incidences now where residential targets are being hit, where commercial targets are being hit, whether that's a bank building, a hotel. So all of those areas now are going to need rebuilding. And we're talking about 13 countries. It's not just what's happening in Iran and Israel. It's countries around that. So companies in those sectors typically do benefit in the aftermath of what we're going through right now.
And would those be how would Canadian companies who might be doing some of that work, how will they be perceived in the Middle East? American companies, would they have the opportunity, or would they be shut out possibly because people might be upset with them?
Well, this is a fantastic question. We really don't know, because we don't know what the region's perception of the U.S. right now is and what it's going to look like after this war. Canada, I think, stands again in a very good place right now, to the extent that we have companies that can actually be involved in the reconstruction efforts that will take place. So if we think of engineering companies like WSP Global, the old S&C Lavalin, those types of companies are already there in different areas of infrastructure, and I think should benefit. But the U.S. question, I think, is open right now.
And then, also open is Iran. We don't know what will happen there, whether there is regime change. Would that open up to the West, or will it stay shut off?
And that's what I'm saying. There's so many unknowns right now. To be able to sit there and say, this is what we're going to be doing over the next few weeks from a portfolio point of view or a strategy point of view really is so premature right now until we get at least some clarity as to what the end game is or what the end date's going to look like.
So are you just kind of sitting on the sidelines right now and just keeping an eye on everything?
Taking a look, daily and at what opportunities are out there. And again, it's interesting. A lot of the infrastructure companies that we just talked about have actually pulled back in the last several weeks. So for us, I think there's some opportunities there to look at whether you want to pull the trigger and now start, deploying capital into areas just because we think that that's going to be a great place to be after this war is concluded. We're going to wait and see, but I think you do have some opportunities there.
And any particular companies focusing on, or just
kind of the ones that we're looking at?
Yeah.
Like WSP, I think is well positioned right now. Again, the stock price has come off in the last little while, so we're definitely looking at that for an entry point. And again, and it's not just the Middle East. Let's keep in mind there's other parts of infrastructure that these companies are going to benefit from as we build out in Canada and Europe and Asia.
All right. And what about energy here in Canada? Is it? I mean, we keep talking about that wake-up call, and we keep talking. We were talking about infrastructure being built and seeing more oil going west to China. I guess to the east. It always sounds funny when it goes from the west, but. Are there opportunities here? Could this be the impetus, a situation like this, where we finally see energy in Canada ramp up or production and access to it?
Yeah, I think so. I mean, the same case can be made for the States. So people that need oil are going to look to the most stable supplier of oil. If I've been buying my oil from the Middle East and now we have a situation where I'm not getting product, I've got to look elsewhere for alternatives, and I think Canada is one of them. So we definitely think Canada, and it's almost like Canada's a Fort Knox right now for crude. And why do I say that is because we're not relying on tankers to get our crude necessarily somewhere dangerous or through dangerous areas. Mm-hmm. We do have the pipelines, and we do have tankers that will take it to customers that we're not having to go through areas like the Middle East. So I think Canada really stands to benefit here. And, a lot of the big cap energy names in Canada, I think, will do better.
All right. We'll leave it on that note there, but we'll be back with Andrew Powell to see why Adobe is on his radar. Time to see what's on the radar for Andrew Powell, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management. You have a cornucopia, a melange, a mix.
That's what I thought we would do today. Just have a little blend, right? We're talking about Iran so much. Let's kind of go out and look at other areas of the market.
And this is a different direction. Watch where we go and watch where we end up. First up, Adobe.
Yeah, Adobe's the big one this week.
Which gets beat up by everybody.
It's getting beat up by everyone. The stock has seen a little bit of a rebound recently. We're getting earnings this week. These earnings will be very much focused on, like every other software company out there. Street has a buy rating on this stock, which is interesting. I think that's more of a value sentiment reflection than extremely bullish on where this company is going. Because as you mentioned, it has been beaten up in the last year. This is a company that 2 to 3 years ago was seen as a darling because it really knew how to integrate AI into its products and capitalize on that. What's happened since then is AI has started to eat Adobe's lunch because now I don't need Adobe to create an image of something, and that's why the stock has come under a lot of pressure. These earnings will be very much looked at.
And what are you going to be looking for in it? What will be the key for you?
I think guidance for one. Even if they come out with a good report, even if they meet analyst expectations, the question now is whether that's good enough to keep this recovery in the stock going. So I think they literally have to shoot the lights out, and the guidance has to be so positive with no gray areas, no vagaries about the impact of AI on them, because that has been the focus. I think they almost have to have a perfect 10, if we want to use a skating analogy on this, to get this stock price to continue to move higher.
And is it a canary in the coal mine for software?
I think it is to a certain extent. I mean, it gets back to all the various, this is a graphics company. This is a company that, again, could have used AI and really capitalized. But we've just found so many ways now, apparently, that we can use AI and circumvent, whether we're talking about Microsoft Office 365, or if we're talking about Adobe products or graphics products. So I do think they are a canary in the coal mine, and they have been, right? This has been reflecting their stock price. Now it's about, is enough? Has this been a disproportionate sell-off in the stock? Now it can actually start to move forward. That's the question that we'll get answered this week.
All right, now we're going to go into real-life Photoshop and touch-ups. Ulta Beauty.
Yeah, so Ulta is a beauty product.
Right here.
We're going to really go on a different tangent on this. Interesting, this is a company that's also going to release earnings this week. The stock has done extremely well. And the reason why I bring it up, this is one of those lipstick index type stocks, right? What do we mean by lipstick index? Well, lipstick index.
Exactly what you mean.
Exactly. Is if things are getting bad and I'm going to curtail my spending on large ticket luxury items, whether they be luxury cars, luxury alcohol, or whatever the case may be, I still want to feel good at the end of the day. So the theory goes, I'm going to default back to something that still kind of makes me look good, but a little bit lower price point. And this theory, we've seen this theory applied, through the last few decades of market activity. And I think this is one of them because we have seen this stock do extremely well versus, again, look at a lot of the other luxury items out there, Roger, that have actually slumped, again, reflecting that economic concern. So earnings come out this week. The stock has done well, buy ratings on the stock, and we'll see what the guidance looks like.
And who's in there? There's some big names that are involved with Ulta, right?
Well, if you know Ariana Grande,
from
she
the
has a line
entertainment
through
side.
them, and Rihanna has a line through them. So some very popular high-end names are through this company. What's interesting, though, I mean, it's typically viewed as a female cosmetics company. However, recently, the stronger growth items have been in teenage boys and men. So the company will, probably in the earnings call say, we're going to see this trend continues because you're starting to see male products show better growth prospects, but it's still female dominated.
All right. And last up, Descartes Systems.
Yeah, so Descartes Systems, again, a Canadian company, earnings coming out. This is going to be, again, another perhaps canary in the coal mine of, are all software companies getting caught in the same fishing net with respect to the threat from AI, or can some of them actually demonstrate that, no, we've got products and services that customers need. It's not going to be displaced by AI. And I think this will be an interesting earnings call for Descartes as well.
And what, again, same, you're going to be looking for what's coming up?
Going to look at, what's the customer flow looking like? What's their guidance going forward? Where do they see the best growth in terms of their platforms that they have? And what has been the impact of AI on them? What we would expect every single CFO to say is, look, AI is positive for us. We're using AI. We're becoming more efficient. There may be some focus on jobs in the report, but I think, again, just like Adobe, you've got to get a fabulous report out of this to justify the stock moving higher.
And have they been using AI? I'm assuming they have been. Have they feel like they've done better than Adobe on implementing it? I
think that, they've got a more better diversification of products that can use AI, right? Because they're more diversified than just what Adobe does. So the answer to that is yes. The question is whether they're still going to get affected by the wave of, can we do something with AI that we don't require this platform? That's where it's critical for them. I would say right now between the two, if I was to pick one, I would pick Descartes over Adobe in terms of companies that can probably get through this and capitalize on AI instead of actually getting eaten by AI.
Do you think that's going to be the case? The ones that just are more focused on a sector or focused on one product are the ones that are going to get eaten with this?
Yeah, I mean, if you've got one product that can be replaced by something else cheaper using AI, you're going to be eaten. If you've got a vast array of platforms that will utilize AI and also bring your costs down, because this is critical right now. If I can get my margins under control, if I can become more efficient, and we're not just talking about can I cut 1,000 employees from my ranks, we're talking about producing things cheaper to be more competitive. And if I can use AI to do that, then I come out ahead of companies that are just simply going to be in a one product state or few product states that can be replaced easily, and margins don't matter at that point, because if there's no demand for your product, it doesn't matter about margin.
All right, we'll leave it on that note there. Still ahead, U.S. CPI data will be released in a couple of minutes. We'll take a closer look at the U.S. economy after the break, and our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266 or send us an email, firstcall@bellmedia.ca. Canada is urgently exploring options with provinces in the energy industry to boost oil supply. This, according to a spokesperson for Energy Minister Tim Hodgson. As trade disruptions caused by the war in the Middle East surge oil prices, Canada is looking at ways to increase output and adjust transportation if supply routes need to be changed. MDA Space is looking to raise $300 million in an initial public offering in the U.S. Last month, the CEO of the satellite company told Bloomberg a subsidiary in the U.S. or Europe would help the company become a government contractor in those jurisdictions. The Brampton-based company did not disclose how many shares it would offer or the price per share. Shares of Campbell's are falling in the pre-market, off by about 5 1/4. The packaged food company saw its profits cut. It's cutting its profit guidance, for the full year. Missing estimates, the American company says results fell short of expectations due to weaker than expected performance in snacks. Storm-related shipment disruptions in January and the associated supply chain costs also impacted sales. Quick look at the markets right now, and pretty much flat. Everybody trying to find some direction. Dow's off by 0.1, and then NASDAQ and the S&P 500, they're a wash right now. Well, the newest American CPI data has just been released for February, and the core CPI rising 0.2% month over month. The estimate was 0.2%. Pretty much all the numbers are right at the estimate. Actually, I'm just looking at them right now. Yeah, core CPI month over month, 0.2. CPI month over month, 0.3. That's what the estimates were. Year over year, 2.4, 2.4. Let's bring our guest back in. Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy. Good, bad, none?
Snore. Yeah.
No real surprise, and it's not a bad thing. I guess it is where everybody figured it would be.
The only way this report would have been market moving, Roger, would have been had it been extremely weak. Because then we could have had a little discussion about, will this impact the Federal Reserve meeting that we're going to see next week? That wasn't the case. It was totally in line. Even if this number had come in a little hot, it's not going to impact next week's meeting. Nobody expects a rate cut by the Fed. In fact, people are talking about, could there be rate hikes down the road? So this report, yeah, it's a snore. It's really nothing. And again, it's happening before Trump went to war with Iran and before oil crossed over $100 a barrel. Where this ends in March will have an impact on CPI. I would argue right now, market participants today are looking forward into the March CPI data.
And that'll be the big, I was just trying to remember what number I saw for every $10 of barrel increase, it's 0.1% on inflation or something like that?
Yeah, so every $10 barrel on oil is 0.1% off GDP growth, a much smaller impact on CPI. And people will say, well, why is that? Well, we don't consume crude oil in the CPI basket. We consume things like gasoline. I think the important thing, though, is oil touches other products, right? We focus on gasoline. What is the pump price? So in the States right now, we're paying 50 cents more per gallon than we were a couple of weeks back. But it's every other product, plastics and everything else that comes from crude. If these oil price increases stick for a longer period of time, then the things that we throw out, like, well, what impact will this have on CPI? I think will fall to the wayside because it could have a broader impact on CPI. It could have a bigger impact on core CPI because core CPI nets out energy. It doesn't net out other products that use oil in them.
And of course, the March number will matter, or it won't matter because we might not be resolved. So we might.
Yeah, this is what we said at the beginning of the show. We have no clue when this is going to end. We may be talking about the only difference, though, if this is not concluded by the time we do the survey for the March CPI data, it will probably show that influence of where gasoline prices are.
Yeah, absolutely.
But
where is it going beyond that, though, is the next question, right?
Well, does it get worse? And I think this is where it gets interesting, Roger, because as we look at where central banks are going to lay interest rates, we're already seeing this in England right now. The Bank of England, we've gone from pricing in one or two cuts to now we're pricing in an actual rate hike. We're not there yet for the Fed, and we're not there for the Bank of Canada. But the longer this drags on and becomes broader in the inflationary impact, we will be talking about that. And that's a completely different variable, I think, for the markets today.
Well, and that's, the markets, a lot of them had it baked in, probably two cuts at the start of the year. That was, so what does that mean for the market? So
some people had looking more, right? Some people coming into this year were hopeful that Trump would get his way and we would get maybe 3 rate cuts over the course of the year, and that would be stimulative for the economy. Those are now gone. To your point, we now think 1 to 2, but the 1 to 2 now is being brought into question. And I would argue right now, the only way you get 2 or 3 is if what we're seeing right now in the Middle East in terms of an economic impact is so severe that you actually now start talking about higher probabilities for a U.S. recession, growth stalling, and now the Federal Reserve in this case has to come in now and provide stimulus. Again, we're not there yet. We've got a long way to go before we start making those calls. For now, I think the Fed is content to just sit tight and watch, just like the rest of us are watching, what is happening in the Middle East.
And then let's throw in a Fed chair change, too, while we're...
Yeah, why not make it interesting, right? And we don't even know where that's going now because, we have members of Congress that don't even want to vote on the replacement for Powell because we have other issues that haven't been resolved, like, suing the Federal Reserve over reconstruction of the headquarters. So there's so many things that are entering into this. It's unfathomable to look at that and say, okay, this is where we're going to go.
Yeah. America doesn't do things simple, do they?
They don't, not as well, especially in the last year.
Holy cow. All right, we'll leave it on that note there. Still ahead, today's market drivers with Bloomberg's Janine Panzer, and our phone lines are open. Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, is taking your questions. You can reach us at 1-855-326-6266. Email firstcall@bellmedia.ca as well. Let's take a look at some of the early market movers, and we're joined by Bloomberg's Janine Panzer. Janine, thanks very much for joining us, and let's get right into it. UniFirst, they coming up first?
Yes, this is an exciting world of uniform. UniFirst shares are up at about 7% in the pre-market trading. Yes, after Cintas has agreed to buy it in a stock and cash deal, valuing UniFirst at a pretty significant premium. It's a $5.5 billion deal. So what's really exciting here is that how Cintas is able to finally acquire UniFirst. It caps a multiple years-long pursuit. So I think investors are reacting to the premium and the consolidation in that space.
That is a long courting time. All right, Oracle, good numbers. Everybody's liking Oracle right now.
Yes, Oracles are reporting strong results, and it has raised its outlook. So the shares are soaring. Last I checked, is in the green at about 10%. It's really showed the demand for AI infrastructures, and company building AI system needs massive computer power. So investors are increasingly seeing Oracle as one of the key beneficiaries in this AI spending boom.
And last up, we've got Nike. How are they doing? What's going on with them?
Yes, Nike shares are in the green pre-market as well. Last I checked was about 2.5%. The move came after Barclays upgraded the stock to overweight from equal-weight, pointing to signs that Nike is starting to turn corner, is making progress in its operational issues, which have some investors worried about. So things like inventory and margin appears to be stabilizing. So yeah, the numbers are showing Nike is starting to turn the corner.
Okay. Janine, thank you very much for that update. We appreciate it.
Thank you.
Bloomberg's Janine Panzer. Well, the war in Iran is continuing to create chaos around the world, and it's not just soaring oil prices that are having an impact. Fertilizer is seeing the prices skyrocket. CTV's Alex Carpa has more on what this means for Canadian farmers.
This is our nitrogen fertilizer.
Fertilizer is an essential part of Kevin Peters' farm in southwestern Manitoba.
This bin will hold about 100 tons of nitrogen fertilizer.
Both his crops and livestock rely on it heavily. But since Israel and the U.S.'s attacks on Iran, the average price of nitrogen fertilizer has skyrocketed around 30% in the last week.
There's always some disruptions seeming to happen somewhere in the world. That's changing our daily prices.
Roughly a third of the world's fertilizer shipments move through the Strait of Hormuz off southern Iran. With the vital shipping route effectively closed, economists say global prices are rising.
Fertilizer very important to our growers here, and especially at the time of year right when we're gearing up for planting season.
Anderson says the world's fertilizer supply was already under pressure before this war started.
This adds another layer of increased cost to their bottom line.
This price increase is yet another blow for farmers who have seen their input costs increase dramatically over the last few years. Jill Verwey with Manitoba's Keystone Agriculture Producers is desperate for the war to end soon.
If this drags out further, then it's going to have bigger impacts on availabilities, capacity for farmers to get that fertilizer on this spring.
Watching a deteriorating crisis for Peters has made staying optimistic difficult.
We're just cautious about overextending ourselves, and we want to be here producing food and producing livestock, for the markets.
Experts warn the high cost of fertilizer and other goods are likely here to stay, even if the war in Iran were to end in a few weeks. Alex Carpa, CTV News, in your Steinbach, Manitoba.
Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including Maple Leaf Foods. All right, let's take a look at some of the notable analyst calls and recommendations. The analyst not going easy on Go Easy. RBC Capital Markets analyst Bart Diazarski cut the recommendation on Go Easy to underperform from sector perform. Jefferies analyst John Aiken cut the recommendation on Go Easy to hold from buy. National Bank financial analyst James Golan cut the recommendation on Go Easy to sector perform from outperform. And in the wake of Maple Leaf Foods reporting earnings and sales in the quarter that topped estimates, Scotiabank analyst John Zamparo raising the recommendation on Maple Leaf Foods to sector outperform from sector perform. PT set to 32 Canadian, implying a 15% increase from last price. And JP Morgan raising the recommendation on Oracle to overweight from neutral. PT set to $210, implying a 41% increase from last price. And to get some reaction to this, let's bring in Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management. Your choice. Which one would you like to talk about?
Well, let's look at the Go Easy one. I think if we were to look at these and look at what was
Since we're piling on,
what is the most substantial reaction that we've seen in the stock? Obviously, Go Easy. And it's interesting, we've been talking about software companies that have been impacted by AI and how we've seen the valuations decline. You know, to your point earlier, there's other things going on in the market, including private credit. And we've had numerous headlines on private credit. The challenges, JP Morgan, for example, is writing down a segment of their loan book. And Go Easy is in that subprime sector of the market, which, you know, it's not private credit. But anything that raises a red flag on credit, generally speaking, will reverberate around. You know, we've made comparisons on the show to 2008, like what happened back then. I mean, so yeah, this is going to be something that analysts are going to be watching for the possibility that this company is going to be impacted negatively, or there's something in the closet that we're eventually going to see. Doesn't mean we're going to see it, but we're seeing that in the stock price.
And do any of the banks have any risk like that, or are they fairly safe on how they do things?
Well, it's the clientele that are going to go to that company for credit are
the
probably
ones that
not
aren't
the clients.
From the banks.
Exactly right. So I mean, banks have an extremely well capitalized structure. Their credit analysis is 100% solid. You're not getting a loan with a bank unless they have gone through every single line item on your financial statement. So that gives the bank a little bit more insulation against bad things happening. Doesn't mean it's not going to happen, but the probability is less. And I think that's why you see companies like this really get hammered, because there's really not that layer of protection that you have with the banks.
And is it a big market in Canada?
Well, it's a very large market, right? And it becomes larger, Roger, ironically, as the economy softens and as we face the challenges like the Middle East, like the potential for inflation to go higher. There are families and households that are disenfranchised by that cannot get access to regular credit because they've lost their job, and they have to go to the subprime market. And I would argue this will be the same in the States right now, where we are seeing layoffs and we're seeing a weaker employment market. I think you will see a lot of these subprime lenders in the U.S. coming under the same kind of pressure.
All right, we'll wrap it up on that note there. Andrew, thanks as always, though, for joining us. You're going to stick around because we've got lots more ahead. Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management. He's going to take your questions next on First Call. Time for First Call and first email. It's from Tim. I would love to hear your guest's opinion on Boralex. BLX, it seems to get no love and no attention. With all the issues involved with oil and the war, they are involved in renewables and are in Europe. I also get a Good Morningside report, and it appears undervalued. Why so little market love?
Well, for one, I think this is a leftover from the total lack of love that we saw during the inflationary impact for these companies. Companies that are relying on debt structures when interest rates went up, a lot of these companies came under pressure. We were just talking off air. I think one of the byproducts of what is happening in the Middle East right now, what's happening to oil, and a lot of investors don't realize this, but there's a very close correlation between traditional energy companies that really are mirroring what's happening to oil and EV companies. And the question is, well, why would that happen? They seem to be diametrically opposed. Well, they're not, because as oil prices go higher, the incentive to go to an alternative, whether that's wind power or whether it's solar, actually goes up. So I tend to believe that these companies actually do better in these episodes. And especially now we're worried about supply of reliable energy. I actually think companies like Boralex will actually do better in this. We've seen the stock basically hit a bottom. So, yeah, we would say this is probably a good company to look at, especially if you're interested in the renewable space, because this is one of the more dominant players in that space. So I do think the outlook looks great for this company as we kind of work our way through another oil crisis.
And and we keep, every time there's a crisis, is this the impetus where we'll push towards green even more, or renewable energies? And is this the one maybe that will do it?
Well, I think, we look at this, we produce a lot of oil.
Yeah.
But we have a lot of countries right now that are getting off of oil. Case in point, countries that use coal to generate electricity now are coming off of coal. Well, where are they going? Well, they're using natural gas right now. Okay, so we've got increased demand for LNG, which guess what is being impacted by this. So do we need to look at another source? And so no one source of energy is going to do it, whether it's wind or solar. But I think those businesses over time will actually accrue value to the investor.
All right. Next email is from Mike. From Beth. I was jumping the gun there. And it says, "Morning, Andrew. Can I get your first thoughts on this Uber times Amazon robo-taxi deal?"
The
future is now.
The future is now. So this is going to be in Las Vegas.
Yep.
So basically, Amazon, these robo-taxis are the Zooks, which is the name of it's a very strange name. These now are going to be used on the Uber platform. So it's fantastic for this group, this company within Amazon. And I would say it's great for Uber, because I think as this notion of taking a driverless car catches on, Uber benefits as well. So I would say it's a benefit to both companies right now, but probably a little bit more of a benefit for Amazon.
And obviously this is going to have, is there going to be a tipping, are we approaching a tipping point with this, that autonomous cars, autonomous cabs, we're seeing them, and people said this would never happen, but now we're seeing them, and are we going to hit that tipping point? But we said that about EVs, and we've kind of stalled a little bit with EVs.
Yeah, I think the appropriate thing there is stall, right? I think the EV progression is going to continue. And again, coming back to EVs, they too will actually gain traction now, pardon the pun, because of what's happening in the oil market with respect to the Middle East. So that tipping point, I don't know when it happens, Roger, but I think it's not going to happen. It will happen. It's just a question of when. And, Las Vegas, I'm sure everyone will just want to take a driverless car to the casino and gamble instead of gambling on your life in the car. But yeah, I think this tipping point is down the road.
All right. Let's get to this email from Mike. I'd like your guest view on Netflix. Thanks.
Well, Netflix is loved by more analysts today than prior to the deal that it was going.
Best non-deal they made, eh?
We see this with so many companies. We talked about this with Couche-Tard last year. Once you take that deal off the table that analysts didn't really like, all of a sudden the company becomes attractive to analysts and hence investors. And I think the same will be true with Netflix. Netflix has a solid platform, a solid business. Once we get this mess of a deal off the table, investors now can focus on a nice, clean play. And Netflix, I think, is a clean play in streaming.
Well, and it allows a company to kind of get focused again, right? I mean, they can get lost trying to get this deal.
Investors hate companies that are not focused, right? If you're not focused on your operation and the bottom line profitability, then why am I buying your stock? And I think that was the case with Netflix. And again, why we're seeing the stock rebound.
All right, we're going to sneak in another email. And it says, "Hi, I was wondering if Andrew could give his opinion on critical metals, in general." And it's from Joe, that email.
Yeah, so we started the show on Iran, so we'll end
Ended
the
on
question
critical.
with Iran, and that is, there were more things being shipped and susceptible to supply chain disruptions than just crude, and one of them is critical minerals. To give you a case in point, a lot of the guided missiles that are being launched into Iran use magnets that help in the guidance system. Well, guess where those magnets come from? They come from critical minerals. So it's, the supply chain risk for the world is only getting larger. And so again, I'll bring this back home to Canada. The efforts that we put on critical minerals in this country is uber important. And because we are going to see increased demand for them, and they're going to see increased demand for reliable sources of those going forward.
And do we have the, I come back to this question all the time with Canada. The Ring of Fire in Ontario, we've been talking about this for decades now. And, we're getting a road to it now. But do we have the courage, I guess, or the impetus to do it?
Well, two different things. Do we have the courage to do it? Do we have the impetus? Or are we going to do it? If we do it, I think the benefits are there. If we keep kicking this can down the road, someone else will come out and say, we're your supplier.
Yeah.
Right now, as we know, China is the dominant supplier, but it doesn't mean they have to remain so. So Canada has an opportunity. The question is whether you've got the guts and the courage to do that, and time will tell.
Time is telling a lot right now. Yeah. I mean, everything is just up in the air. The other one, going back to the Middle East, I was fascinated by how much aluminum comes out of there, and if that's not getting through right now as well, too.
Yeah,
You'll
see that reflecting. It's everything, right? It's not. We are so laser focused on the oil, but we miss everything else that could be impacted by this if it continues. Now, if we're over by Friday,
right,
we don't worry about aluminum. We don't worry about semiconductors getting through. But if we're playing this game for 2 or 3 more weeks, then those things will be impacted.
All right, Andrew, we've got to wrap it up there, and it's not even 9 o'clock yet. Okay,
Thank
you to Andrew Pyle, Senior Portfolio Manager and Investment Advisor at Pyle Wealth Advisory, CIBC Wood Gundy Private Wealth Management. And Andrew's up next with the Open. Trading gets underway in about 30 minutes from now. Have a great day.